Welcome back to Explain the Charts, your go-to source for unbiased market insights. Today, August 14th, 2025, we're diving deep into the SPY, the S&P 500 ETF, which is currently at a critical juncture. Just yesterday, news reports were buzzing about the S&P 500 logging back-to-back record highs, fueled by surging bets on Federal Reserve rate cuts. However, just hours ago, the narrative shifted dramatically as Producer Price Index, or PPI, inflation came in much hotter than expected, causing the Dow, S&P 500, and Nasdaq to slip. Looking at the daily chart for SPY, we can clearly see the long-term bullish trend that has been in play. The index has been consistently climbing since the sharp correction we saw in April 2025. Notice the significant volatility in early April, particularly the massive red candle on April 4th, followed by another on April 8th. This period marked a substantial pullback, testing previous support levels around the $495 to $500 range. But then, zoom in on this powerful green candle from April 9th, 2025, showing an incredible 11.18% jump, effectively reversing the downtrend from those prior days. This strong bounce back from the $493 low demonstrated significant buying interest and established a new, strong support zone around $490 to $500. Since that pivotal moment in April, SPY has resumed its upward trajectory, pushing into uncharted territory. The move to new record highs yesterday, August 13th, saw the price reach approximately $646. This level now stands as immediate resistance, particularly considering today's inflation news. Should the market continue its current reaction, we might see a test of near-term support levels. Let's switch to the one-hour chart to get a clearer picture of the more immediate price action around recent highs and volatility. Here, we can observe the price trading relatively tight around the $635 to $638 range through late July. Notice the sharp decline that began on July 31st, specifically around the 1700 hours Universal Time Coordinated Candle, where price dropped from nearly $638 down to $633 within an hour. This rapid move, followed by further declines into August 1st, where it touched lows around $619, indicates that underlying concerns were already brewing, possibly anticipating economic data. This hourly perspective shows that while the daily trend remains strong, short-term pressures can lead to significant pullbacks. The $620 to $625 range appears to be an important short-term support established during that early August dip. Now, drilling down to the 15-minute chart, we can see the swift ascent that led to those reported record highs in the past few days. The candles on August 12th, particularly from the 12:17 Universal Time Coordinated mark, show a strong bullish impulse, pushing from around $636 up to over $642 by the end of the trading day. This rapid upward movement continued into August 13th, confirming the bullish sentiment that was prevailing before today's news. The current immediate resistance for SPY sits at the newly formed all-time high around $646, reached just yesterday. So, what does all this mean for trading SPY? From a long-term perspective, the overall trend remains bullish, especially given the market's tendency to buy the dip. However, the hot PPI inflation data released today introduces a significant bearish catalyst in the short term. For bulls, the argument rests on the underlying strength of the economy, the expectation of eventual Fed rate cuts despite this inflation hiccup, and the market's consistent ability to recover from pullbacks, as demonstrated powerfully in April. They would be looking for the price to hold above key support levels. Conversely, bears will point to persistent inflation forcing the Fed's hand, potentially leading to a more hawkish stance, which could undermine equity valuations. A break below recent support levels would reinforce a bearish outlook. In the short term, expect increased volatility as the market digests the inflation data and what it means for Fed policy. A definitive breach below $640 on the daily close would suggest further downward momentum is likely. A strong break above $646, on the other hand, would invalidate the immediate bearish reaction and signal continued strength, though that seems less likely given today's news. Key price levels to watch in the short term are the $640 mark, and then the prior support around $630. More significant support lies around $620 to $625, and for a deeper correction, the psychological $600 level could come into play. In the long term, keep an eye on the $550 zone, which held strong during the significant April correction. Unbiased prediction: we are likely to see continued downward pressure in the very short term, possibly testing the $630 to $635 range, with a moderate likelihood of around 65% for this to occur if inflation worries persist and no immediate Fed reassurance is given. A break below $630 would increase the probability of a move towards $620 to approximately 75%. Conversely, if we see a quick bounce and reclaim above $640 by end of day or tomorrow, then the previous bullish momentum may still hold sway, reducing the likelihood of a deeper correction to 30%. Things to look for include upcoming CPI data, Fed commentary on inflation, and employment figures, which will all heavily influence market direction. Always remember to manage your risk, use stop losses, and conduct your own due diligence before making any trading decisions. That's all for today's in-depth analysis of SPY on Explain the Charts. Be sure to like, share, and subscribe for more market breakdowns.